Welcome to the Country Club podcast, but not the kind with dress codes and tea times. This is a different kind of country club, one where country living meets real estate, community, and adventure. I'm your host, Diana Cassidy-Bush, and your trusted guide to navigating life beyond the city limits. Whether you're looking to plant roots in a small town, find the perfect recreational escape, or make smart investments in rural properties, this podcast is for you. Because in real estate and in life, it's more than just about buying property. It's about making the right plan, seizing opportunities, and building a future you love. Welcome to the Country Club, where home, community, and opportunity come together. Welcome back to the Country Club podcast, where we talk about all things country, home, community, and lifestyle, and I'm so glad that you're here. Within the podcast, I try to focus on important topics related to three pillars: live, play, and invest. In this episode, we're going to focus on the investment pillar and talk about one of the largest expenses you face in the investment space, and this is surrounding everyone's favorite topic, tax. Tax is a very important consideration to anyone who owns real estate or anyone thinking about investing in real estate, and it's a critically important factor to bring into the equation, especially at the time when you're thinking about selling. Today, we're diving into a talk about a tax that's been on the top of everyone's mind when it comes to homeowners, investors, and anyone keeping an eye on the real estate market: the updates to the capital gains tax, which was announced in this year's federal budget. Joining me is Ben Bryden, a chartered professional accountant with Wilkinson Company. He brings extensive experience in tax planning and financial strategy. Ben works with individuals, families, and business owners across our region to help them navigate the often complicated world of taxation, especially when it comes to real estate and investment properties. A fun fact about Ben: he spent much of his childhood growing up in the Flinton area and now practices in the Belleville-Trenton region. In our discussion, we'll be breaking down what these new capital gains changes actually mean, how they might affect both homeowners and investors, and what other tax considerations sellers should be aware of heading into the new year. Ben, thank you for joining us today. We're glad to have your expertise at the table. I just want to start off. There's been a lot of discussion and general confusion about capital gains taxes and the proposed changes that were set to be implemented in June of 2024. I know in discussions with people about their personal holdings that were not their primary residences, second properties like investment properties or cottages, there was a lot of upset people initially. There's been a lot of media coverage about those tax changes, but not a lot recently. I was hoping, Ben, you could shine a little light on all things capital gains as it relates to real estate in December of 2025.
Fabulous. No problem, Diana. Thanks for having me. Essentially, it's been quite of a roller coaster ride in the past couple of years for capital gains. Back in budget 2024, there was a kind of a shocker introduced when the capital gains inclusion rates were being upped. So typically, capital gains, only 50% is included in your income, and the proposals essentially had 2/3 of that being included in income. So it was a kind of an artificial tax hike on capital gains. That measure was supposed to come into effect in June 2024, and up until January 2025, that was the understanding for everyone. So a lot of people had done a lot of transactions prior to that date in order to crystallize their capital gains at that lower inclusion rate. What happened in January, though, is the Canada Revenue Agency wasn't ready to release the new forms, so they decided that in January they announced that they were going to defer that change until January 2026, which caused a little bit of an uproar because a lot of people had already done transactions based on the fact that the legislation was supposed to be changing. Long story short, come March, when the government is changing leadership, it was decided that whole legislation would be canceled entirely. So in March of 2025, that change in inclusion rate was essentially canceled, which then resulted in a lot of happy people, but also a lot of upset people that had done transactions based on the anticipation of a higher tax rate on capital gains.
What I experienced as a real estate professional was there was only about a 6 week to 8 week time frame when there was a bit of a heads up that that change would have been coming into effect. So I think it would have been a little bit challenging for people, unless they were just yard saling property, to get things sold within that time frame.
Exactly. So the federal budget in 2024 came out at the end of April, and then the transition date for the capital gains inclusion rate was towards the end of June. So essentially, you did have that brief window of time where everyone was scrambling, maybe in real estate sales, accepting an offer that they maybe wouldn't have otherwise accepted
Yeah.
at a lower price just to avoid the higher tax implications. So
Mhm.
again, a lot of people upset by having to do that and making decisions based on that before, and then the rug got pulled out a couple times.
You know, in hindsight, they probably did okay considering that the real estate market has continued to come down since then. But yes, I can understand people being upset about the back and forth and not having clear answers.
Absolutely.
So, what do you think might have prompted the changes, and what might the government be trying to achieve here?
I would say a lot of the changes are more of say a political based change. Essentially, if you want to increase taxes without actually increasing tax rates, then changing a capital gain inclusion rate is something kind of a little bit more complex. That maybe applies to maybe some people that have a little bit more wealth, a little bit more uh, ability to dispose of assets and recognize as capital gains. So essentially, it was a way to generate tax revenue without actually explicitly upping tax rates themselves.
Got you. It seems that the general public and even the real estate industry at large seems uninformed about the latest development. Do you have any insights into why they're not really broadcasting the updated information?
And again, without going too far into the political spectrum, there's definitely some political reasons behind the kind of the whiplash of going back and forth in relation to the capital gains. There has been some media coverage when it was initially released, and some media coverage in relation to some of the changes. But I think a lot of times it's maybe okay. This was an era of we introduced something that the general public didn't like, and now we want to kind of move past that piece of it. And most notably, in the most recent budget in November, there was nothing in regards to capital gains rates changing or anything like that. So they were kind of just
Sweeping it
um,
under the rug?
yeah, sweeping it under the rug. Yes.
Got you. For someone selling a second property like a cottage, rental property, or vacant land, how might their tax situation look now?
You're taxed on the capital gains, and so what capital gains are is essentially the proceeds of disposition less your cost base, and including selling costs. So what happens in that situation is you recognize that profit and include 50% of that on your tax return, unlike the two-thirds that was proposed. So based on that, you're paying tax whatever your marginal tax rate is. So it's dependent on your income. So if you have particularly high income, then you're paying tax at a much higher rate than someone with a lower income recognizing a capital gain. There is that difference in tax treatment for capital gains that is a little bit more beneficial than just regular income.
Are there any strategies or timing considerations that a seller might want to think about if they're planning to sell in the not too distant future?
The best course of action in relation to selling and timing your sale of a property is really driven by your income. So if you have a particularly high income in one year, maybe you wait until the following year to sell your property so your gain is recognized in that particular year, because it's based on the marginal tax rate that you're in right now. Timing as far as like the fiscal year and the taxation year, either a fiscal year of the corporation or the taxation year of the individual, that can also play into it because it can result in tax deferral. If you sell at the beginning of the year, then you don't have to pay taxes until, say, April 30th of the following year. So there is that timing differential that you can also work with. More recently, in 2022 and introduced in January 2023, is kind of a 12-month rule. So if you're an individual who buys a house and then disposes of that house within a 12-month period, it's automatically included as business income as opposed to a capital gain. Unlike a capital gain that 50% is included in your income, business income is 100% included in your income. So if you're buying a house and then selling it within a 12-month period, you do have an automatic application of these rules. Those rules were essentially developed to stop flipping of properties, or penalize flipping of properties. Prior to those rules, there was kind of some criteria that you would have to meet. So like essentially your intent had to be to buy this property and with the intent of selling it. There was a number of other factors that might be involved in there, and that like they could look at like how long you've owned the property, how long, what industry you're in. So like for example, a realtor that's buying a property and selling it within 12-month period, or even beyond that period, and kind of doing that habitually, CRA might say that's not a capital gain, that's business income, because that's what you're buying it with the intention of making a profit on it. So under the new rules, though, regardless of what your intent is, and regardless of how long you're owning the property, if you sell it within that 12-month period, the application of the business income is automatic. So essentially, you have to carve yourself out of that by having one of the exceptions, and like you have to prove to CRA, the Canada Revenue Agency, that the move was driven not by your intent to earn a profit on it, but driven by other life events like the death of a family, a change of job, or something along those lines. And previously it was the other way around, that Canada Revenue Agency had to prove that you were intending to sell it within that period. Now this automatic application, you have to prove against that, essentially.
Okay, and just to clarify, so if I purchased a property April 30th, 2025, as long as I sell it after April 30th, 2026, we don't have to apply that application, or it closes?
Right. So the automatic application doesn't apply, but the old rules will still apply, and it will
I
still
see.
look at some of the frequency of your sale transactions and that, and like what your original intent was. But essentially, that would be Canada Revenue Agency having to come back to you and disprove the fact that it's a capital gain, and say that no, you've done this as an adventure or concern in the nature of trade. Essentially, you're doing this as a business as opposed to buying the property to like live or rent it.
So if someone owned more than one property and they were looking to dispose of them, it probably would make sense to consider what the tax implications would be.
Absolutely. So when you own more than one property, you have what's called a principal residence exemption, and you can apply that to any property that you've ordinarily inhabited during the year. So, for example, a person with a house and a cottage, you can argue that you've ordinarily inhabited at some point during the year each of those properties. So when you dispose of one of them, you have the option of claiming this principal residence exemption to offset the capital gains that would otherwise arise on that property. Just to elaborate a little bit more on the principal residence exemption, it's available for any property that you live in, your spouse lives in, or your children live in, or your common law partner live in. For example, I guess if you own a house for yourself, but you also own a house that your kids are living in, you can claim the principal residence exemption on either one of those properties. And a lot of factors go into like determining whether it's more tax efficient to claim it on one or the other. Typically, we would look at how long you've owned the properties, how long you intend to own the remaining property, the accrued gain per year on each of the properties. And then once you decide on the sale that you're going to claim the principal residence exemption, you file a very specific form with your tax return, the T2091. And that's designating that particular property for however many years you want since you've owned it as your principal residence. So that can shelter the full capital gain on it, but it comes down to making a choice when you own two properties of which one you're going to claim it on.
So once you sell that property and then say return to your main address, will that property be then looked at for capital gains in the future?
Absolutely. So what happens in that situation is if you designated say you've owned a cottage for 10 years and you've owned another house for 10 years. You sell the cottage and you claim it as your principal residence exemption. You don't have to pay tax for that entire 10-year period. When you sell that capital, you recognize that capital gain and offset it with the exemption. Now for that 10-year period, because your cottage was designated as your principal residence, your house can't be designated for that 10-year period. If you own it for
I
another
see.
5 years, so you've owned the property for 15 years, you can designate 5 of the 15 years that you've owned it as your principal residence. So it will bring down your capital gain, but it won't completely eliminate it.
Great information. Thank you.
No problem.
So any other gray areas that homeowners should be aware of, like for example, partial use or rental or a home business that they might want to just be aware of when they're making decisions about what to do with the property?
Yeah, so going back to the principal residence piece of it, one thing that's very key is that it only applies to your house and the land necessary for the use and enjoyment of your house. The CRA generally considers that to be 1/2 hectare. If you're in a situation where you have a large parcel of land attached to your house, there is a portion that could be carved off and subject to tax. So it's treated as 2 separate transactions. You've got your principal residence transaction, and then you've got your excess land transaction. And that excess land piece is going to be subject to capital gains tax. When you're using a property for something else, so say you're using it for a farm business, or you're using it for some other commercial business venture, or you're renting out a portion of the property, then you do typically have to apportion between how much is in relation to your house that you can claim principal residence and how much is in relation to everything else. When you're looking at the principal residence exemption, if you say you live in a duplex and you live in one unit and you rent out the other unit,
Hmm.
when you sell that property, you have to apportion the value of the proceeds based on which one is your primary residence and which one is the duplex piece, or the rental piece of the duplex. And so you're recognizing a capital gain on that duplex piece, but you're not, or the rental piece of the duplex, but you're not recognizing it on the personal portion of it. If you're, say, renting out a room of your house, you have one entrance, one main address, it looks at what the primary purpose of you owning that house is. So typically when we see primary in the Income Tax Act, it means more than 50%. So if you're using more than 50% of your house for your personal residence, you can claim the principal residence exemption on the whole thing. But if you're using less than 50% for your principal residence, then you have to apportion between the two. That only applies when it's kind of a mixed area use, like you have one address, you have one entrance, there's no clear delineation between your personal property and the business portion or the rental portion property. So you really need to be careful as far as, like, if you are using your house for other adventures, say you have a business within your house, that you're not using more than 50% of your space in your house for that business, because then you can compromise your ability to claim the principal residence on the whole property.
When it comes to primary residence or additional properties, any gray areas that we haven't talked about there?
So other kind of tricks and traps and all
Yeah.
that fun stuff. Well, there's a lot of gray areas when it comes to the Income Tax Act. It's not necessarily all black and white. Every exception has an exception, and so it's kind of a web of rules. But a lot
Right.
of the times, what we see in our practice, a lot of the kind of key areas that cause hiccups, one primarily is the change of use of a property. So if you've got a property that you're using as a primary residence, and then you decide that you're going to start renting that property, that's considered a change of use for income tax purposes. By default, that's actually subject to a deemed disposition. So that means you can inadvertently trigger a capital gain on the change of use of a property from either a primary residence to rental or rental to a primary residence. So those issues often come as a surprise to individuals, because I mean, they continue to own the property, so why are all of a sudden they paying capital gains tax on this property that they still continue to own, that haven't received any proceeds of disposition? So what happens in that situation is, if you don't do anything, you're subject to capital gains based on the fair market value at the change of use. If it's a primary residence, you can kind of get away with it by claiming your principal residence exemption. But if it's a rental property that you've now moved into, it's more of it's an unsheltered capital gain. So there's things that you can do at income tax time in order to avoid triggering that capital gain. There's special elections you can file under the Income Tax Act to deem that change of use not to have happened, and that helps defer the capital gain until you actually dispose of the property and have actual proceeds to pay the tax. So it's very important that if you are changing use from a property from one thing to another thing, that you're talking to your accountant and at tax time in order to make sure that you're filing the election. Because if you don't file the election, you have a capital gain, and if you late file the election, it's $100 a month penalty for late filing it. So that's one of the bigger things that we see in our business when we're preparing tax return is kind of a rental income suddenly appear or disappear off a tax return, and we have to ask the question like, okay, like what are you doing with this property? Did you change the use of this property? And then kind of go through that election process. So that's a pretty big one that we see in our business, as far as kind of surprise things that can happen to a taxpayer owning a residence. Other things that we might see, HST is always a big question. HST, whether HST applies to a transaction, HST rebates on transactions. If you're selling vacant land as an individual, generally as long as you're using it for personal use, it's not subject to HST unless you've severed it more than twice or used it in some sort of business. Like if you've been renting the farmland to someone, then theoretically you might have HST on that transaction. Then there's new housing rebates and rental rebates available for individuals and corporations that are constructing new houses for either living in or renting. So there's a whole bunch of kind of tangent HST rules that can apply in a transaction, particularly when dealing with new residential property or when dealing with land that's been used either in a commercial endeavor or owned by a corporation or anything like that. A lot of times when you're thinking of listing a house that you've built or listing some land that you've built, you really need to consider whether or not HST applies on the transaction, so it's not a surprise come sale time when you're eating an HST cost of 13%.
Yeah, it's always a good idea to consult with your accountant to get advice on how they see that carrying out based on your use.
I mean, I'm always going to, I have the bias to consult with your accountant, obviously, but when you're dealing with big dollar numbers when it comes to real estate transactions, it's better to get as many professional advices as you can in relation to that transaction so you're not causing a huge tax hit or a missed opportunity that you could have otherwise taken advantage of.
Yeah, nobody likes those kind of surprises. How important do you think it is to track improvements and costs to help calculate the capital gains when selling or HST?
Again, my personal bias is track everything. You do need to make a distinction between what's capital and what's a repair and maintenance cost, because capital improvements to a property will increase your cost base of the property, which effectively reduces your capital gain on that property. When you actually dispose of the property, you need to be able to support that adjusted cost base if the Canada Revenue Agency asks for detailed information. So when you do that, typically CRA has a record retention period of 7 years, but when it comes to supporting the adjusted cost base for a capital property, there's no 7 year rule. You need to be able to support everything. So if you did an addition 20 years ago, you need to have details of that addition from 20 years ago in order to
Wow.
support your adjusted cost base. Otherwise, it'll be disallowed and you might have a higher capital gain. If it's just your primary residence and you only own one residence and you know you're going to claim the principal residence exemption on that property, it doesn't really matter too much. But circumstances can always change. Like it might be a situation where maybe you're thinking that this is going to be your primary residence forever, but later on you decide that you're going to buy a cottage and maybe the cottage increases in value and you want to claim principal residence against that. Now all of a sudden your primary residence has this capital gain. And a lower or higher adjusted cost base is necessary to kind of offset that capital gain. So going back to my original comment, the distinction between what is a capital improvement to a property and a repairs and maintenance is not always clear. Typically, the Canada Revenue Agency views a capital improvement as something that increases the value of the property beyond what it was in its original condition. And the distinction, there's some very clear ones. So like if you're painting walls, that's generally not a capital improvement. That's a repairs and maintenance, unless you're painting the walls for the very first time. They're unpainted and you're painting them for the very first time. Sometimes it's a bit less clear. So if you have a roof and it's a shingle roof and it's fallen in disrepair, if you replace that roof with new shingles, then that's considered a repair and maintenance because you're replacing it with something that is similar to what it was originally, just in a better condition. But if you're replacing that roof with, say, an upgraded roof, like a steel roof or something along those lines, then that would be a capital improvement because you're increasing its value beyond just the shingle roof that it was prior. Another example would be a situation where you have countertops and you're replacing your countertops because they're in disrepair. You're replacing them with the same similar countertops, similar materials. That's considered a repair and maintenance, even though like the value of the property is increasing. But if you look at the original condition of the original countertops, it's comparable to what they are now. But if you're replacing those countertops with, say, marble countertops or something a little bit fancier, then that can be considered a capital addition. And so if you keep track of those capital additions, those improvements, you can increase the adjusted cost base when it comes time to calculate your capital gain. But you do need to be able to support them. So it is very important. Create a folder, have a folder in your, stick all your capital improvement invoices in there. So when it comes time to sell your house, you can give your accountant a nice, neat folder saying, here's all the invoices that were our capital additions. Have at it.
Yeah, and even if you're not sure, better to have the
Yeah.
documentation
When
and
in doubt, stick it in that
Mhm.
folder. Yeah.
Yeah. One tax that we've covered a lot of tax information here, but one that we haven't touched yet is like estate planning and inheritance tax as it applies to a property, changing from one maybe family member to another.
Yeah. So there's a lot of rules in relation to when someone passes away. The general rule is when someone passes away, they're deemed to dispose of all the property they own. One exception to that rule is if it's transferring to a surviving spouse. So if you have a house that you own, you pass away and it's going to your surviving spouse, there's no tax event at that point in time because it happens on a rollover basis. But if you have a house that you pass away with and you're passing it along to your kids, then there's a deemed disposition of that house. And again, the capital gains are recognized based on the fair market value of that house when you pass away. So that can trigger capital gains on your final tax return. You can claim the principal residence exemption to offset that. Your estate can designate that property as your principal residence, so that can save some of the taxes. A lot of times, if you own multiple properties, you might have this large tax hit, and maybe not the liquidity in your estate to actually pay that. So if your estate is very asset heavy, like a lot of real estate, but not a lot of liquid cash or investments, then it might be a situation where your estate is having to pay a significant amount of tax and not really having the liquidity to do that. So they may have to borrow against property. They might be forced to sell a property. So you got to take that into consideration. A lot of times you can avoid that liquidity issue if you have appropriate life insurance or something along those lines, that you can have that kind of proceeds come in tax free in order to pay down the tax liability that's arising on the deemed disposition of your real estate. There's special rules in relation to real estate that's specifically used in the farming industry. So if you have farm property that you've been using in a farm business, if you meet a certain set of criteria, there's a couple things that you can do to offset that. One is there's the lifetime capital gains exemption, and that applies to very specific property for each individual. And effectively, since the 2024 budget was announced, you have $1.25 million of kind of tax sheltered capital gain if you dispose of this eligible property. And one of those eligible properties is farmland that's been used actively in a farming business by the individual, their spouse, their kids, or a relative. So a lot of times, if you pass away with farm property, you can shelter the capital gain that arises on that with this lifetime capital gains exemption. Or even if you dispose of farm property during your lifetime and it meets the criteria, you can claim that capital gains exemption to offset that. With farm property, there's also another set of rules. If you don't or aren't eligible for the lifetime capital gains exemption, but you've still used this property in a farming business primarily, then you can actually roll that property over to your kids in your passing for them to use in the farming business. So there's special rollover rules in relation for farmers that are available that might allow you to transition farm property to the next generation. And when I say used in a farm business, one distinction that is typically missed is that renting farmland to a farmer isn't considered a farm business. That's considered a rental business. You actually have to actively be farming the business in order for it to be considered to be used in a farming business.
Very interesting. Lots of tangled web rules to,
Absolutely, yeah.
yeah.
Again, yeah, every rule has an exception and every exception has an exception.
I like how you put that. Any last pieces of advice for anyone as they look forward to 2026 and what they may want to do with a property or multiple properties that they own?
Uh, I mean, the key takeaway is this: that we're dealing with when you're dealing with real estate, it's large numbers. You're dealing with potentially huge tax liabilities. You're potentially dealing with like huge consequences. So it's always best to talk to your realtor, to talk to your accountant, to talk to your professionals, to get their opinion before you do the transaction. I can't tell you how many times someone has come to me after they've done a transaction, and I said, "Well, you could have done this, this, and this to avoid
Yeah.
all of this." So the biggest thing is talking to your professionals prior to executing the transaction. Other than that, like because the capital gains inclusion rate hasn't changed, it's still at the 50%. There's no immediate urgency as far as tax incentive for selling a property or holding a property or doing any of that stuff. But who knows what the future brings? Each year there's a new budget, and each year that comes with a whole new set of tax rules. So it's sometimes hard to say what's going to happen from one year to the next. I believe now the federal budgets will be coming out in the fall of each year, where previously they would have been in the spring. So each fall we'll see potentially a change in tax legislation that could have ramifications to the housing market. And I'm going to say the housing market is typically one that is under a high level of government scrutiny as far as like constantly updating tax legislation or constantly auditing or triggering reviews of real estate transactions. So just keep that in mind when you're considering whether you buy or sell, or you're understanding that like the rules now might not be the rules 10 years from now or 5 years from
Yeah.
now even.
Or 2 years from now.
Exactly.
Yeah. Yeah. Awesome. Well, thank you so much for lending your expertise today, Ben, and leading us through all these questions and kind of clearing up some misunderstanding with regards to the capital gains tax as it is today in December of 2025. That's been great.
No problem. Thank you, Diana, and thank you for inviting me to talk. If there's one thing I love to do, it's talk about tax. So
One of the few people that love to talk about tax. That's great.
fabulous. Yep.
Ben, thank you so much for joining us today and helping us unpack capital gains changes and the broader tax considerations that come along with selling real estate. This is one of those areas where good information truly empowers people, whether they're planning a sale, thinking about investing, or simply wanting to understand how these rules affect their financial picture. Your insights today were incredibly valuable, and we're grateful that you could share your expertise with our listeners. And for everyone tuning in, thank you for spending this time with us. As we close out the new year, we hope this conversation leaves you feeling more confident and informed heading into 2026. If you have any questions about how these changes might affect your own plans, always make sure to connect with a trusted professional who can guide you through the details. Be sure to join us in January, where we kick off the new year with an episode about setting your real estate intentions for 2026. From making smart market decisions to preparing your home or cottage for a future sale, and everything in between. It's going to be a motivating and practical conversation to start off the new year strong. Until then, thank you so much for being a member of the Country Club. Happy holidays, stay warm and safe out there, and I can't wait to see you in the new year. Thanks for joining me at the Country Club today. I hope our conversation has helped guide your journey. Whether you're looking to plant roots in a small town, find the perfect recreational escape, or invest in rural properties, every situation is unique, and I'm here if you need a trusted resource on your real estate journey. As always, consult with a qualified professional before making any investment decisions. I'm Diana Cassidy-Bush, and I'll see you next time with more conversations about thriving beyond the city limits. Click the follow button for the Country Club podcast with Diana Cassidy-Bush on your favorite podcast platform, and let's start building your future together.